Now we're going to bring you the latest business news on the programme. We're going to look at the sell-off, in fact, in the global bond markets, which has very wide-ranging implications. Charles Pellegrin, our business editor, is here on set. He's going to make sense of it all for us, aren't you, Charles?
Well, to give you an idea, just the U.S. bond market is worth $25 trillion. And as a reminder, Stuart, a bond is basically a government note that, that says it will pay the creditor back at a fixed rate and a specific time. It's basically a form of government debt. This is happening as the yield on these bonds in the U.S., basically the return that one can make by investing in such a treasury, is steadily rising to levels not seen in 16 years. Well, one of the reasons for this is that the U.S. government's borrowing needs are increasing. For the 3 months leading to September, for instance, it has issued $1 trillion in debt. And it's also the result of interest rates looking like they'll stay at a higher level for longer, as central banks vow to stay the course in the battle to reduce inflation. Well, especially in the U.S., where economic data is showing resilience in employment and output. These higher rates increase the cost of financing for companies on the stock markets, who are now seeing a better rate of return investing in bonds rather than shares. Well, let's take a look at the yield on a 30-year U.S. Treasury, for instance. On Tuesday, it hit a 16-year high, getting closer and closer to a 5% yield, a level not seen since around 2007, just before the financial crisis. Well, this development is having a negative impact on equities this Wednesday. European shares at the opening lower as investors look at these yields move higher, a data point that's often used as a gauge for investor confidence. As you can see, the DAX in Frankfurt leading the losses down 0.75%, the Paris CAC 40 down just under 0.5%. In Asia, the Kospi in Seoul and the Nikkei in Tokyo closing lower as well. The Nikkei, the Kospi in Seoul leading the losses down almost 2.5% as it just that in the marketplace opened after a public holiday. The Hang Seng in Hong Kong also lower. Mainland Chinese exchanges still shut for the Golden Week holiday. Moving on, TikTok Indonesia said it will end transactions on its e-commerce marketplace by Thursday in order to comply with new local regulations. The announcement comes after the Indonesian Ministry of Trade last week set a deadline for TikTok to become a standalone app without any e-commerce feature or risk being shut down. The move comes after President Joko Widodo recently called for social media regulations. He said platforms like TikTok had contributed to a sales decline for domestic businesses by flooding the market with foreign imports. And in the U.S., Hollywood actors and studios have resumed talks. This is opening up the possibility that their strike could come to an end, following in the footsteps of the Screenwriters Union last week. Actors and studios have been divided on issues of pay, on the issue of artificial intelligence, as well as that of increasingly having to self-tape their auditions. Union members are optimistic about their prospects. Take a listen.
I'm so happy that the writers have a deal because I really feel like that gives us positive momentum moving forward with the AMPTP in negotiations. There's a lot that's going to be similar. There's a lot that's different, but I feel like it puts a lot of positive energy and positive movement moving forward with the negotiations.
Well, meanwhile, the Wall Street Journal is reporting that streaming platform Netflix is planning to raise the price of its ad-free subscription after the actors' strike ends, or at least a couple of months after that. This would be yet another price increase for the creator of a hit show, Stranger Things, and would likely begin in the U.S. and Canada. On average, ad-free streaming subscriptions, Stuart, have gone up 25% in the past year or so, as the industry looks for profitability and is looking to encourage customers to move away from its ad-free subscription services and towards its ad-supported subscription services, which are more lucrative and cheaper for customers.
Yeah.